Good afternoon. Can everybody hear me okay? Thank you for joining us today. I'm Kirsten Leffler. I'm the Assistant Director with the Family Business Center. And as always, we want to thank our sponsors, Fifth Third Bank, Eastman & Smith, Shoemaker, Loop & Kendrick, Huntington National Bank, Highland, William Vaughn Company, Rehmann, and Skylight Financial Group. Events like this would not be possible without our sponsors, so thank you. Our speakers today are from Huntington National Bank and Rehmann. An economist with over 25 years of experience, Dr. George Mokrzan, is Director of Economics for Huntington National Bank. In that capacity, he provides economic analysis and commentary to management and clients, giving them insights into the global economy as well as the local economies served by Huntington. Dr. Mokrzan first joined Huntington in 1996. He has been recognized as an important source to turn to for commentary on employment, manufacturing, and international trade and its impact on the Midwest. Previously, Dr. Mokrzan was both the Vice Chairman and Chairman of the Economic Advisory Committee of the American Bankers Association. For 10 years, he served on this national committee that meets regularly with policy officials. He is a panelist for the Federal Reserve Bank of Philadelphia Livingston Survey and also serves on the CNN Money Economist poll. Dr. Mokrzan earned a doctorate in economics from Duke University in 1990 with a specialization in macroeconomics, international economics, and econometrics. He earned a master's degree in economics from Duke University and a bachelor's degree in economics from the University of Rochester. We also have Mr. Tom Shemanski joining us today, and Tom has nearly 20 years of experience as a chief financial officer. Prior to joining Rehmann in 2017, Tom was a founding partner and CFO for a business consulting firm that primarily serves small to middle market companies. And he also worked for 10 years as a CFO of a $110 million multi-site tier 1 automotive supplier. Tom has significant experience in financial executive leadership, business financing and debt restructuring, facilitating rapid turnaround and profitability, and assisting organizations through ownership transfer and leading company acquisition teams. Throughout his career, Tom has completed over $20 million in debt restructuring projects utilizing a large network of lenders and relationships to successfully refinance properly positioned companies. As an involved member of his community, Tom serves as chair of the Jackson High School Ambassador Dinner and Auction and has served on the board of directors for a number of local nonprofit organizations, including the Jackson County Chamber of Commerce. So please join us today in welcoming Dr. George Mokrzan and Mr. Thomas Shemanski.
Well, good afternoon, everyone. I don't think I've ever had such a comfortable seat for an economic forecast. So this may impact my forecast here. So just to let you know, my bias me a little bit. We're certainly in interesting times here this year. The economy slowed down this year after 2 very robust years of growth. And a lot of questions have been raised. Well, if the economy is slowing down, will it slow further? Will we turn into a worse downturn? Will we move into a recession? And I think that what we need to do, and what I'm going to try to do today, is kind of step back and take a look at some of the economic fundamentals, which I think, for the most part, do gain short shrift, particularly if one looks strictly on a day-to-day, what's in the news type of information flow. And those fundamentals actually are quite good. And in general, even though the Federal Reserve last year was tightening monetary policy, and actually was one of the reasons why the economy slowed this year, they actually have been easing monetary policy. They probably will ease another quarter point tomorrow. And they certainly are on watch for further reductions. And those interest rate reductions are important because with a lag, they tend to lead stronger economic growth. We've obviously seen that with central banks across the globe, actually. This year, 16 central banks in the third quarter actually eased monetary policy. So that easing of monetary policy should support the international economy. Some easing in monetary policy by the Federal Reserve should also improve the situation next year. And I think the policy uncertainty around trade, at least it's de-escalating a bit. And I think that also could be a positive going forward. All right, now I won't, expect you to read that. Certainly this will be available later on. But the key points here are that the consumer is in very good shape in the U.S. economy. And the consumer typically leads the economy. And I think that the data supports that the consumer is even stronger than typically the case and should be able to provide a good lift to growth in the next year. And that certainly is going to be important. There is softness on the manufacturing side. There is softness on the goods side of the economy in general. A lot of that is the international economy effects. Slowdown in exports, strong dollar has been a headwind for some manufacturers. Commodity prices have been under pressure, whether they're agriculture, energy, other prices, steel, other commodities as well that are key to the economy. Our region of the United States tends to be above average in their sensitivity to manufacturing, to that international economy. So we're feeling a little bit more than the national economy. But overall, the U.S. economy is expected to continue to grow. Next year, actually a pickup in pace and growth from what we expect in the fourth quarter. And with that improvement, essentially a continuation of the longest economic expansion. This is a general list, if you will, of strengths and weaknesses of the U.S. economies, or strengths and risks. And it's really led by factors that are supporting the consumer: strong labor markets, rising wages, solid disposable personal income. Again, the Federal Reserve is now supportive of monetary policy. Fiscal policy is argued that it's been neutral, but that's actually not the case. The fiscal policy that was implemented with the 2017 Tax Cuts and Jobs Act is still having positive effects, primarily on the supply side of the economy, but still a positive for economic growth. Certainly the outlook in the long-term environment, if you will, for business investment in the United States has clearly improved. And a lot of that was with the U.S. becoming more competitive internationally. Even before the tax cuts, costs were rising in China and moving on really on parity with the United States. That's a very different fundamental than we saw in the last decades when obviously this part of the country got hurt quite a bit by jobs flowing outside of the country. So even without the additional support of the fiscal reform, the tax cuts, the U.S. is becoming more competitive. And we've seen that also in manufacturing jobs growing during this economic cycle. So that's often kind of overlooked as well. The recovery really has been going on for a number of years. In addition, housing has been recovering gradually slowed again last year, and that was one additional factor in the slowdown in growth recently. But that is starting to see some new legs with interest rates going down, especially on the long end, on mortgage rates. Energy sector, the United States, of course, now is the biggest energy producer in the world. That basically removes a big risk in past cycles when energy shocks, if you recall, clearly slowed the economy and caused recessions as well, or contributed to recessions. That's not likely to happen again, given the huge energy supplies, a lot of that coming from technological innovations. And finally, just a fundamentally strong business sector compared to the international economy. We still have businesses that have a lot to say with what happens in those businesses. They have a lot of autonomy. If you talk to, many of you probably have talked to business people from abroad, they can't lay off workers, for example, even if they're bad workers, because of restrictions. There's a lot more freedom overall for U.S. businesses, and I think that's a positive in the long term. Certainly, we're seeing some risks, slower economic growth, trade policy uncertainties. I think it's had an impact on business confidence, but I don't think that that's an insurmountable one. And I think to a certain extent, a lot of that just comes from uncertainties. And when the actual math is done on a lot of these tax policies, it really is not as significant as maybe some of what the market makes it out to be, and some analysts and businesses. There is rising debt among businesses, and so that is kind of if that continues, I think that could become a risk that could ultimately slow the economic recovery. Geopolitical risks are everywhere. Obviously, Middle East has got the news recently, but there's also conflicts in Asia, in India and Pakistan. We've had North Korea. There are different places in the world where obviously things can happen. So those are there. Brexit got extended here recently, but at least when I came down to the 11th hour, there was some sign of compromise. So that's at least somewhat reassuring that something will be done there that will be at least allow that to happen without too significant negative repercussions on growth. High long-term debt, that is an issue. And that's something that also is a risk in the long term. Housing affordability is becoming a factor for some, but it's really not too much of an issue in our part of the country. And I'll show some charts on that if we have some time here as well. I put in some kind of swing factors. Ultimately, we need to find out what the ultimate final impact on U.S. terms of trade will be. I do think it's forgotten sometimes that there were 7 reasons why the administration started implementing the tariffs, and they were largely because of competitive reasons with regards to China. We'll have to see how many of those 7 issues get resolved in the coming months and maybe years. U.S. labor competitiveness has kind of become a question mark. Obviously, with the unemployment rate rising, more businesses are complaining about not able to find workers that are qualified. So that, again, is a challenge, a longer-term challenge. And capital spending is also going to become an issue. It's been a bit slow here in the second half of the year, and it's going to be important for the capital spending to keep strong in order to keep that labor productivity growing, which has been actually on the upside. When I have a few charts now, so I hope that most of you are graphically oriented. This is the ISM, Institute for Supply Management, and it shows the manufacturing, which is in red, and non-manufacturing, which is in black, and you can see the combined index. And because manufacturing is really a relatively small part of the total U.S. economy, that black line is very close to the composite in size. And what you can see is that we have had a slowdown, but we've had a slowdown from very strong economic growth. So basically, we kind of moved back to the norm for this economic cycle in 2019. Growth that was comparable to before the 2017-2018 period here. Another thing that's important that this chart highlights is that manufacturing typically is pretty volatile. And it has dipped now, and some have basically point out, well, this could be an indication that the recession is coming on. But in fact, this is the 3rd time that manufacturing has basically gone into contraction during this economic expansion. So manufacturing alone being volatile, there's a lot of factors involved there. Inventory is one of them. Inventories have been quite high, and there typically is a bit of an inventory correction, which is going on this year. Slowness in the international economy. Maybe some cyclical slowing, but you wouldn't see that in auto sales, would you? So again, that that manufacturing dipping is, we are forecasting that it's going to be a temporary one, just like the previous two. And if you look back at the previous cycles before the other recessions on this chart, one can see also that it's not unusual for manufacturing to go into a contractionary period. It happened in the 1990s, around 97, 98, which we're going to come back to, that period. And it also happened once there in the previous expansion, and actually slowed significantly, even if there wasn't an outright negative number. This is the GDP forecast on a quarterly basis. You can see the very strong GDP numbers, really 3%, 3.5%, not unusual for a quarterly GDP number in the last couple of years. We're seeing a slowdown. So that first gray one is the third quarter. We're going to get that GDP number. Probably is going to be a little bit on the soft side, but the consumer spending is going to be great again in that quarter. But business spending is a bit soft. So that's taken away from the economic growth here in the near term. Ultimately, we get into next year, a lot of the monetary policy that I was talking about earlier is going to start having a positive impact. And to start to promote stronger economic growth, and also a general stabilization of the international economy, which is in the forecast. A lot of attention, and especially on the recession type worry side, was a function of the yield curve. Now, the yield curve did invert this year, and there are different ways to measure the yield curve. Many economists, including myself, view the most important yield curve as the difference between the Fed funds rate target, which is the short-term rate that drives the 3-month treasuries, and a 10-year treasury yield. And you can see that did go negative primarily because the 10-year had declined significantly. A lot is made of that, but there's some nuances and differences between this time period and others in the past. Certainly one of them is that the international economy is having a bigger impact in terms of bond yields. Interest rates came down significantly into negative territory in Germany and other places. A significant portion of bonds are actually having negative interest rates now. That put downward pressure on the U.S. Treasury, and that was independent of the U.S. economy. And in addition, the Federal Reserve themselves have been buying long-term bonds, and that's putting downward pressure on the long end as well. So the long-term interest rates don't necessarily reflect economic fundamentals as they have in the past. And we're starting to come out of that. You can see we're starting to edge back towards zero and above zero. As the Fed cuts the rate here a little bit more as expected tomorrow, that probably will move into positive territory again, which is healthy, at least for confidence. And if you look back at previous periods, yes, the yield curve did go into a sustained negative period prior to the previous recession. But if you look to the recession in 2001, the yield curve was actually going negative quite frequently during that time. And it did not lead to recession. So a yield curve inversion is not necessarily the bona fide, all-powerful indicator that points to a recession. Okay, now, for whatever time I have, I'm sorry if I'm taking too much time. I just want to focus on some of the strengths here. The consumer is very strong. Here's the unemployment rate in the economy. We've had recent unemployment rates of 3.5%. That is the lowest since the 1960s. I remember that as a kid, so that was a good time. But it's interesting that during all my work life, and many of our work lives, the unemployment rate has been quite high in the United States. And that actually has come down significantly. Consumer confidence is high, even though we got a little more volatile. It's been staying in that higher range, if you will. And if you look at this chart, this actually indicates that consumer confidence is the highest since 2000. And what's, I think, even more important for our part of the country, which we're the blue section there, the blue line, or excuse me, we're the red line, we're the red section. If you look back towards the previous decade, we definitely were not as happy as a nation. There was a clear divergence there. Obviously, that had a lot to do with jobs, manufacturing jobs going away. That's changed during this cycle, and now we're not really much different in confidence than the rest of the nation. And that's a huge improvement. We're not only on par with the nation, but we also have confidence as high as the 2000 period, going back a couple of decades. Looking at consumer finances, this is a financial obligation ratio, includes interest expenses, but also things like auto lease payments, property taxes, insurance, pretty comprehensive measure. And this, relative to disposable income, is the lowest, again, going back to the early 1980s, and now the second lowest on record. So again, strength of the consumer. Consumers are saving more. They're able to save more. So we're starting to see that curve is never high enough, especially for us bankers, is never high enough. But it is improving. Unemployment claims. This is extremely low, especially considering that the economy is quite a bit smaller now, quite a bit larger now than it has been in previous decades, and again at historic lows. Worker participation is rising, but still a bit low relative to the recent couple of decades. So there's still more work to be done in the labor markets, still more people that could come out. Maybe they need a little bit of help, retraining and so forth, but there is some large potential there. The Midwest leads in job opening rate, basically jobs relative to the size of the economy. Ohio is above average, well above average in this regard. So labor markets are very strong. There's in terms of demand for workers. This is the consumption, or at least a big component of consumption, retail sales. You can see the really sharp acceleration in retail sales in the last couple of years, dropped off sharply in the beginning of the year. That was a big factor, actually, that slowed the economy down this year. That followed the financial market volatility that occurred in the fourth quarter. Recall that it was almost a 20% drop in the S&P 500, and worries had consumer confidence basically had temporarily weakened, but it has been coming back throughout the year, and it is accelerating and on an accelerating trend again. And I make one more point here. A lot is made of the tariffs that are coming into play. The tariffs actually have been coming on for the last couple of years. They will be broadening to a lot of the remaining imports from China, many of which now are on the consumer side. And so that 15% tariffs are already having an impact, if you will, on consumer goods. And I think it's worthwhile to take a look at this in perspective. Obviously, there's going to be some inflationary impact, price of goods. But looking at the long term, this shows what what's happened in inflation in the last 20 years, since the new millennium. If you look at that dotted line, you can see that basically the CPI has risen about 50%, which is quite a bit if you think about it. And the question is, where is that inflation coming from? Well, it turns out that most of that inflation is coming from services. Frankly, all the inflation is coming from services. The services less energies, rents, and all the individual components. Medical care costs are going up very sharply. That's the black line. And the highest inflation that I could find was for the category of tuition, school fees, and childcare. So you can see that depending on what you spend your money on, you got hit by inflation, or you didn't get inflation. If you spent most of your money on goods, and less food and energy, including cars, by the way, there was deflation, literally, almost deflation, flat prices. So that, again, we're getting this disruption in goods markets, and a lot is made of that, especially by companies that earnings are hurt by that, and that's true. But in a macro perspective of the total economy, those price increases don't have the relevance, actually, as many of the inflation factors in these other sectors of the economy. And just one more point on the consumer. You can see the red debt relative to GDP that's peaked during the recession. That's been coming down sharply. Consumers have been improving their balance sheets. Businesses, on the other hand, have been raising their debt relative to GDP. And the governments had a very sharp increase in debt relative to GDP early in the cycle, and that's kind of leveled off at 100%. But to the extent that the economy continues to grow, that should help that government ratio to stay relatively stable. So with that, I could go on, but I apologize for going as long as I did. So, and
All right.
please,
I'm going to stand up.
thank you.
All right, so they asked me to put together a presentation on a changing economy. No one wanted to use the R word, so we wanted to talk about how can we prepare for whatever the next change in the economy may be. So start to put my head around that, and a lot of people ask me, well, how do businesses handle this? How do they prepare? What type of tools do they use? And you know, there's a good chunk of people that follow this practice. So this is some strategic plans that I come into in businesses. They get so busy with what they're doing, running their business, that they really don't see what's going on. You know, George's, information is just flying around them, and they just can't kind of resonate that that might impact their business at some point. So how do we avoid this? Thought we'd start by talking about some of the attributes of change in the economy. Speed of change. Technology, information, everything changes so much more quickly now that as businesses, we have to be able to react a lot quicker. We need to be more nimble. We got to be more flexible. So we got to understand that, once the first couple dominoes fall in a period of change, things accelerate very quickly. The days of, well, let's give it a couple quarters and see what revenues are going to do. You just can't sit back and wait. You have to be much more reactive. Momentum. Once the change happens, you have to be prepared to be in it for the long haul, because it's like an ocean liner. It doesn't turn on a dime. So you got to have your company prepared to weather the storm, to give you the runway to make the change as the environment around you changes. And another big attribute, especially now, seems to be confidence. In the economy side, people talk about these confidence ratings, and businesses really need to have that strong self-confidence for their stakeholders, for their employees, for their customers. People need to know that you've got a good plan, you've got a good method of managing your business through times of change. So if we look at it, I think I went too far. If we look at it kind of at a 30,000-foot view, there's really two areas I stress to folks that, these are areas that you need to be carving time out to develop in your organization. One is really simple. It's just planning. Are you allocating the time in your business to plan? Are you allocating the time to have the ability to analyze data in your business and answer some of these hard questions? If my revenue goes up, if my revenue goes down, how does that affect my workforce? How does that affect my machine utilization? What does that do to my real estate footprint? How are those costs absorbed if business rapidly goes up or rapidly goes down? Break-even points. What happens if I drop 10, 20, 30% below my break-even point? Do I have a plan? Do I have kind of a phase one, a phase two, a phase three to look at some of these things to develop a plan so when the time comes, I'm ready to react? It's probably one of the biggest challenges I see for businesses is they're just slow to react once the indicators start to come in. And then by the time they do react, they don't have a plan. So now they're trying to hustle and get a plan together, and time is so valuable in these very dynamic, changing economic times. And to help with the planning is do you have the tools? I'm a financial person, so I think, well, what would I need from a financial side? Well, I should probably know where my cash flow is. Do I have a 13-week cash flow? Can I take that 13-week cash flow and can I expand it to 4 to 12 months? Can I do some revenue assumptions over those 4 to 12 months and really see how does that affect my working capital? I think that's a lot of the bankers that I work with, companies always are coming to them and saying, boy, I'm really growing, I'm out of cash. Or man, sales have gone down, payroll's getting tight. Well, they're coming pretty late in the game. If they had these forecasting tools, they would see it 6, 3, 4 months out in advance on where the sensitivity is in their business. And because all businesses aren't, if you just look at your balance sheet, it's a one snapshot at the end of the month. A weekly forecast sees your highs and lows. Every business has a high point in cash in the month and a low point. You really should know where your low point is on that week during the month, because that's always going to be where the low point in your business cycles. And so that's where you measure. If our revenue drops, how low does my low get? And do I have the reserves to manage that? Financial models too. How does my overhead cost look at different revenue levels if revenues drop? Can I absorb all my overhead? Those are just some things that businesses need to have, along with just traditional metrics. Front-end metrics on your sales, your lead generation, your pipeline. Those are all things that are early indicators on the front end that if my pipeline's down, if my lead generations are down, the revenue is going to start to slide at some point. And do I have the plans in place to address that? So if we kind of take it down then, probably the biggest challenge is resources. Everyone would say, hey, I'd love to have a robust strategic plan. I'd love to have all these robust tools, but I don't have the time. I don't have the people. So just take a couple, first steps. First prioritize your list. You might say, boy, I'm just going to put a cash planning tool in, and I'm just going to focus on that. And I'm going to set a date. I'm going to try to get that in place in the next 90 days. So just take a couple first steps into putting some of the tools and some of the planning in for your business that maybe you don't have. But with a lot, it's a proven practice that if you don't make a plan, you don't put some dates to it, odds are you're going to be 6 months from now still wishing you had those same tools in your business. So prioritize your needs, pick something, measure your progress, and go. So that really is, kind of breaking it down from the 30,000-foot view. There's a lot of other areas I thought we could talk about, but I just wanted to focus on 2 specific areas that might, shed some light onto some areas that you could put some focus into. This is the first one, cash. Everybody's heard cash is king. There's really 2 attributes. It's not only cash, but it's really having availability to credit. We become, you see it on some of the economics, how personal debt's gone down. People become much more debt averse, which is a good thing, don't get me wrong. But as you prepare your company for changing economic times, you need to be sure that you have adequate cash reserves and you have adequate availability to liquidity, whether that's a line of credit, whether that's an equipment line or something that gives you some additional protection as your business goes through changes and maybe forces you to make some change in direction. So, a couple of things that we can talk about from a cash perspective is inventory turns. I see a lot of businesses that run with less than efficient software systems. And so when their software systems aren't efficient, what do? The people that buy stuff buy more because they don't want to get in trouble for running out. So a renewed focus on inventory turns and utilizing your systems to be more efficient is a really kind of a low-hanging fruit area to try to drive cash into the business. Another one is accounts receivable days outstanding. I go into a lot of businesses and they're like, well, they pay 60, 75 days, and well, how frequently are you calling them? Well, if it gets to 90, I'll put a call in. I don't want to bother my customer. We're real happy to have their business. And the reality is the squeaky wheel gets the oil. I mean, if you're constantly calling and just very politely asking, I just wanted to check when this invoice is scheduled for payment a week ahead of time instead of 15 days after the payment date, you're just able to set the tone with your customers on what your expectations are. There's a lot of big companies that say 60 days and they pay in 75. They say 30 days, they pay in 45. So when the economy starts to slow, that's the first place people are pushing to improve their cash. So if you're not aggressively on the phone and emailing, on the portals, checking when your payment dates are, it's an easy way to help speed up the cash flow into your business. And again, don't be too debt averse. And I'll give you one example area. Sometimes I get clients that they'll have term debt, equipment loans, maybe something on a building, and they're like, oh man, we did pretty well last quarter. I think I should pay that debt down. I think I want to pay that debt down. And what I try to reiterate is that, a line of credit is one thing. You pay a line of credit down and you can draw it back up so the availability doesn't go away. You reduce your interest expense. That's a great move. You've got a 5 or 7 year or 10-year piece of term debt. You pay extra principal. There's no easy mechanism to get that money back. You've paid it down. The bank is appreciative or maybe not appreciative depending on how much they are depending on that interest income. But I encourage people, just give it another 6 months. Just wait a little while before you make those decisions on paying down additional term debt, because once you pay it down, in 6 months, if the economy softens, and you might go back to the bank and they might say, well, we appreciate you paying that down, but things have changed. We're not maybe lending as much right now because the economy's bad, or your results, maybe revenue losses. There's some things there that won't make it as easy to get that cash back. So I do try to encourage clients to really closely look at that term debt piece and not get too aggressive, because that bottom phrase is sometimes it's availability over cost, because you can all remember back when the last recession, people just needed capital, and it wasn't what's the cost of the capital, it's just it wasn't available. So as you're in your business and then we're going through these cycles, you just have to keep that in mind, that keeping your availability and your liquidity is just as critical as keeping your cash reserves, because you don't know. Big machine goes down, you need $40,000, $50,000 quick to get it repaired and get it up and running. You need to have that liquidity and access. All right, so this is another. I do a lot of work on product costing. So I come into a lot of places and they'll say, well, we quote, I shoot for 10%, but we get 4, we get 5, we get 6, and you start digging into where, what's really going on, and it kind of points out that there's this, costing is one of those areas where companies maybe don't quite understand what exactly it costs to make their products. So I thought, Dilbert, this was kind of fitting. We really know what we've got, we just don't know what it costs. And so, there's a lot of business owners that sales background, really entrepreneur, really aggressive about growing that top line, but costing is usually the hang-up of where, when businesses fail to execute, costing is generally an area that is one of the struggle points. So, if we look at product or service costing, it's really should be the center of your planning process because, I use the term gross margin with all my clients, and that's sales minus direct cost. So what's left to pay all of our overhead and what's left to put profit, in the company. So, things like machine and labor and SG&A rates, ask yourself, when's the last time we've done a deep dive on that? What rates are we using per hour? Are they still accurate? Are they still up to date? You'd be surprised how many times I ask that question and the company will be, oh yeah, we updated those like 3 or 4 years ago. It's like, oh, okay. Anything changed in the last 3 or 4 years? Revenue-wise, overhead-wise? So, that's something that, it's got to be looked at on a regular basis. Should be looked at annually, at least at a high level to say, has the business changed? Are the rates we're using, are they still in line with how our business is operating? Have you done a cost allocation study? Sometimes people don't realize how much a customer draws for resource or a particular product line. They just kind of treat everything generic. Well, our maintenance department supports kind of everything. But when you dig behind dig a little deeper, you find that 1 or 2 machines really use all the maintenance people because they got a tent right outside. They just kind of camp there and they got to keep that machine running. But they're only charging that machine 1/7 of the overhead for maintenance because they just kind of spread it equally. So a cost allocation study is a really good exercise to see where our dollars are going, either on a product level, a machine level, or a customer level, to see if we're really assigning the right cost in those areas. The other thing is your ERP system. I mean, they're designed to really give you good costing information, live up to the minute cost information. But it takes a fair amount of work to get them there. And I see a lot of companies implement systems, then they just go with generic rates, and they really just don't actively use them to the extent that they can. So it's a question is, how's your utilization? Are you using that tool to automate your cost collection, to really give you the feedback you need to manage your business from a costing standpoint? And I mentioned earlier too, on the quoting side, how much follow-up are we doing when jobs are complete versus how we quoted them? I mean, it sounds like it's a very simple concept, but I really find that it's like people go from job to job or contract to contract, and they get so excited about getting that contract in, they're off to the next one. 6 months after that project's up and running, how closely are you looking to see, well, how did we do versus our quote? Because really, once the people who quote it, they're on to quote new stuff, and then the people that actually have to service or do the work or build the product, then now they're dealing with it. So it really shifts into another department. So do you have someone facilitating that closed loop feedback to your front end sales organization to say, hey, we did a good job quoting that, that work, or boy, we only made 2%. That really wasn't worth the effort. We got to relook at how we quoted that. So again, having that consistently redone. And then, from a budgeting standpoint, are you really looking at this contribution margin, gross margin? Because as companies look to grow their business, do you have the tool to see what happens if I lose this product line versus that product line, right? Because there's differences in margin there between all your product lines. So it's really important to have a good tool where you can look and quickly react, because if the economy starts to slow down and you lose a bunch of business in a low margin product line, it's maybe not the end of the world. You lose a big amount of volume in your most profitable product line, you're going to be like, man, we didn't lose that much sales, but boy, we lost a lot of profit. We lost a lot of margin. So it's really important that you understand what your margins, what your costs are, and what's driving your business. So as it changes, you can use those tools and make sure that you've got the right plan. So that is, that's it. So I tried to keep it short and sweet and give everyone just some high-level points on what we can do for preparing for the economy. But I think in summary, it's the planning, it's the tools, and having that ability to maneuver your business in a changing environment. So, questions? So I guess we'll open it up for some questions for either of the presentations. Sure.
So, I had a million questions actually, but I try to narrow it down to just one. So we have the Brexit, it's the ongoing negotiation in Europe. We have sort of the American isolationism that we've kind of been dealing with this year. So the real question is the WTO doing enough to really to recouple the global economies, or are we going to head down the path of more separation and decoupling of the global economy?
I think that a lot of the concerns have been that the WTO has not been enforced the way it was meant to be enforced. That the rules were good, but people weren't following them. And perhaps there was a general complete openness to free trade, which is trade is good, but sometimes, as a lot of the recent discussion has been, there may be competitive issues where, in fact, China's doing certain things, perhaps stealing intellectual property that is not consistent with a competitive model. I think that it's going to be important. I don't think it's necessarily the case that we're moving back all the way. We'll have to wait and see. But I think that there's we're kind of going through a period where all these countries are kind of taking a hard look at what the rules are, if it's a fair playing field, and looking forward to a more constructive, longer-term type trading relationship. There's a lot of interest, for example, in China's market is huge. And the original thinking was that there'd be specialization, I think, and that the exports would be much more significant to China if the economy is growing. And some countries are enjoying quite high exports to China. Germany, for example. But we're not at that stage. Looks like we're kind of working towards getting to a stage where the rules are laid out more clearly and more fairly. And actually, the long-term potential is tremendous. If China, for example, does some of these 7 different structural changes that the United States administration wants, that should open up their market not only to us but to worldwide and change the arrangements. So we're kind of in a different stage. Still hasn't been determined. I don't think we're necessarily moving towards a stage of no trade, however, in isolationism. I think it's just a matter of kind of taking a harder look. But again, that is my opinion.
Any other questions?
Yeah, if you could, one for either of you guys, whoever's most appropriate, specifically address the European region and your projections for the euro in 2020.
Yeah, the euro is actually not done very well this year, obviously. So that should be giving them a competitive advantage, and to a certain extent, it probably is. That was part of the easing of the monetary policy impact that's been going on this year. The European Central Bank in general has got some of the loosest monetary policy in the world. The problem with Europe is they have the structural issues. Obviously Brexit is one of them. High debt in Italy and some of the tensions over fiscal policy between the countries. Very different points of view on that. Germany might have their fiscal situation intact, but we're talking about the structure of businesses and how their ability to respond to shocks, for example. As Tom is talking about, you have a tremendous array of options, and you have the power to do that. You may do it in the United States. A lot of those companies there don't have all that flexibility. So that kind of goes to one of the points that the United States is a strong economy that is flexible, and that flexibility in itself helps to make a recession softer and even to reduce the risk of recessions as well. I would say that Europe is probably on the weak side. There's a big need for structural change there, and they're working through it. Obviously, it's more than economic issues. The immigration issues have been big there. Again, these are complex issues that involve many different things, both economic and non-economic.
Any other questions?
Yeah, what's the future of the LIBOR rate?
Okay, the LIBOR rate is getting phased out, and they're bringing in a new rate, SI4, and that again, I think there are a lot of technical issues with getting that transformed, but that will be a change. So I think probably a lot of companies have been going by LIBOR now for years. A lot of banks have been lending based on LIBOR. That will no longer be the case. That'll be changed over. It will be a market-driven rate.
Actually, I have two questions. One of the last times that we saw a reasonably high GDP growth rate was in the 80s. And interest rates in the 80s were in the mid to upper single digits. Today, with interest rates where they are, we haven't been able to get GDP growth rate of about 3.5%. Do you think that low interest rates are restricting GDP growth rate? First question. The second question is, what do you think is causing the illiquidity in the repo market?
What's restricting there are demographic factors that are involved in GDP, as well as the productivity factors. I mean, the economy has actually worked quite a bit different in the 1980s than currently. So that's one of the reasons why the longer term type GDP growth is lower. There are concerns about the low level of interest rates. If the economy picks up here, I don't think it's necessarily the case that interest rates are going to keep going down. If the expansion continues, I think the Federal Reserve will stop and start raising rates. So it won't be as low. I don't think it'll be as low as it is currently. But in terms of the low level interest rates, it's still creating quite a bit of liquidity. So a quarter point move in interest rates actually is adding quite a bit of stimulus. So that's another issue, that the actual as rates, even though the rates are low, the actual rate cuts are still supportive, and they are actually increasing liquidity in the economy. And that kind of leads to the second part of your question. The reverse repo situation it kind of made the headlines, and it was, maybe it kind of swept under, I'm not swept under the rug per se, but it was de-emphasized because it was kind of a technical issue with basically the Federal Reserve not able to suppress interest rates as low as they wanted to. So that interest rate was spiking up. Now, part of that was just was because of high debt and different other cash flow issues. They actually came in, and in order to maintain low interest rates, they did purchase bonds, which injected a lot of reserves into the system. So effectively, they eased monetary policy in the last month just to keep those repo rates in line. There was something. They're temporary, but they're kind of continued, if you will. So effectively, they dropped interest rates. Because they couldn't keep interest rates lower, they had to inject more liquidity. So it's kind of a supply-demand problem in a money and banking class. But that's basically what it is. You know, in order to lower interest rates, you increase money supply, you increase liquidity. That money supply and liquidity will ultimately have a positive impact on economic growth with a lag. probably starting next year. And it ultimately is the liquidity, more so than the interest rates, that are important for generating economic growth.
Any other questions?
Yeah, with the reduction of the interest rate, do you see business getting the biggest bang out of that, or do you see the consumer getting the biggest? Which direction, or both?
Well, if you're a business, then there's lower borrowing costs, so that would help in investment, whether it's investment in capital equipment or in inventory.
Yeah,
The lower.
I was gonna say, I don't see much stimuli on the business side. You know, most of my clients, it's nice if the interest rate has gone down, but you know, it's not really driving a lot of decision making on capital purchases or things along that nature. So it helps, but with people being much more risk averse, it seems like a lot of companies are, I'll just take that less amount of interest and reduce my expense. But I don't really see it stimulating well, I'll say under $100 million businesses, which is my space. I don't see that really serving as a big stimuli, because that group overall is still, the last recession is pretty fresh in their minds, and they're not that stimuli isn't encouraging capital spend.
Yeah, I think the consumer side will benefit some more. Auto sector, those reductions in interest rates certainly are stimulative. So that'll likely have a positive impact, including this area. I'll have actually many more things to talk about there, but one of them is that in the auto sector, it is a real big change, obviously, towards away from traditional cars towards larger vehicles, SUVs. And literally, it is a recession in autos, but it's a boom in trucks, SUVs, and larger vehicles. So that's a structural change, and that structural change is also causing, that's one of the reasons why, that's the major reason why the auto industry is having these tensions right now.
All right. Any other questions?
As you look at the inflation with higher education in particular, I mean, what's the end game there? As that continues to rise at an exponential rate, eventually your return on investment becomes pretty hard to get. Same with healthcare. I mean, those two are unrelated. When you look at that inflation chart, those are two big things that really stuck out to me. And obviously, cost of healthcare impacts cost of insurance, which is typically what gets a lot of the attention, but the underlying cause is healthcare. So how do you feel about the future of those two industries in the next 20 years?
Well, obviously the demand has been there. The demand has been there to drive up keep those prices rising, keep that inflation rate high. And it's almost phenomenal how those lines are like raised. They're straight lines. So it's almost set exactly what the price increasing. Again, it's great to talk to a group of businesses. When you're forecasting, it'd be easy to forecast what the price is 5 years from now, based on current projection, and if it keeps going the way it was the last 20 years. I think it's a microeconomic problem. It could be policy issues and related to that as well. And again, it's the demand side. Ultimately, focusing on what the demand is, what is the willingness of people to pay those prices.
Thank you, Tom, George. It was very informative, I think, for everyone. And thank everyone for coming. I wanted to let you all know November 19th is our member recognition event, where that will be at the Toledo Club. There's flyers on the tables. So take a look. It's at 5:30, and we will be featuring Les and Seth Gold from the TV show Hardcore Pawn. They will talk about family business, how it was highlighted on their TV show, and some of the things that they went through, and that it should be really entertaining and interesting. So we hope to see you all there, and thank you all for coming today. And thanks again, you guys.